Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, is Canada creating enough jobs to keep up with population growth? And with rates up and staying there, when might borrowers get relief? Plus, taking on big tech can feel like a game of whack-a-mole. Are we getting it right at all? That's all ahead. First, for the week that was in business, it's time for the briefs. There were 64,000 new jobs created in Canada in September, while the unemployment rate held steady at 5.5%. Wages were also higher, up 5.3%. There were similarly strong numbers in the U.S., and taken together, the data suggests the inflation fight may not be over. A read of U.S. manufacturing signals modest recovery. The Purchasing Managers Index, or PMI, a survey of U.S. production firms, showed a slight rebound with a reading of 49. That's the highest level since November 2022. However, a number below 50 still signals a mild contraction. On the plus side, businesses reported a sharp drop in the cost of their own goods, a positive sign for overall inflationary pressure. The minimum wage rose in 6 provinces this week. In Ontario, it rose to $16.55 an hour. Manitoba is now at $15.30, while Nova Scotia, PEI, and Newfoundland and Labrador all rose to $15. Saskatchewan raised as well, but to $14 an hour. The remaining provinces and territories saw no change in their wage rates. Meanwhile, there is an increase in the share of Canadian workers who feel financially stressed, according to a survey from the National Payroll Institute. The group described the findings as a financial storm, as the number of workers in distress jumped 20% to 37% overall. 63% of workers who described themselves as stressed said they're spending all of their pay just to stay afloat. The report found that 35% of those who report stress earn more than $100,000 a year. Canada's biggest grocers have responded to a request from the government and promised to cut prices. Less clear is which products, by how much, or for how long. Even less clear than that, how it will help resolve entrenched supply chain inflationary pressure. But at the very least, Thanksgiving dinner may be slightly more affordable. Birkenstock plans to sell shares to the public in a transaction that could value the German firm as highly as $10 billion. The footwear firm is enjoying a renaissance, with sales climbing double digits and a pair of its pink sandals featured in the recent Barbie movie. And those are your business briefs. The economy continues to produce jobs, and wages are climbing by more than the central bank must want. What does that suggest about the direction of the overall economy? Stephen Brown is Deputy Chief North American Economist at Capital Economics. Thanks for being with us.
Thanks for having me.
So I think safe to say stronger maybe than a central bank might want right now. What's your first impression of the strength of this data and what it might mean for where rates go in the country?
Yes, it was one of these somewhat odd employment reports where the headline numbers were significantly stronger than all the details within there. So there was sort of a 60,000 increase in employment, but when we look at the sector details, that was driven entirely by the educational services sector, whereas employment elsewhere edged down on the month. Likewise, with wage growth, the year-on-year rate was very strong at close to 5%, but the month-on-month change, once we adjust for seasonal effects, is only 0.2%. So in annualized terms, we're talking a little less than 3%. So it's not really as strong as the central bank might think.
So that we'll take that as good news, of course, because many are hoping for relief on rates ahead. Does that suggest we might well see that we're at or near a high watermark for rates?
Yes, I think there's very little chance of the Bank of Canada hiking again now, particularly not just the economic data, but also what we're seeing in global bond markets. So interest rates have been rising across the world this week, and that's likely to put further pressure on fixed mortgage rates, at least in Canada, and represents a new downside risk to housing, unfortunately.
And of course, we do have population growth in this country that we need to factor in when it comes to our jobs data. How do you factor that here? Because I've seen StatsCan say we need 50,000 jobs created a month just to keep up with population growth.
That's right. One of the sort of unusual things about this month's data as well is that we didn't see the unemployment rate rise as a result of strong immigration and more people looking for jobs. But there were still signs of that immigration in the data. Again, the types of jobs being created are normally those at the moment that pay lower than average wages. So sort of the high contact services that were affected by the pandemic are still recovering. But a lot of the jobs we might be thinking of as long-term productivity drivers, say professional services, manufacturing, those are still looking quite weak. And I think that's another concern for the Bank of Canada.
So finally, I have to ask you the question, of course, that we're going to keep asking, and that is, will we dodge a bad recession? What's your current thinking on that?
I think this is one we've ummed and ahed on. We had a recession in. We sort of thought we maybe needed to take it out. We're still forecasting effectively a very mild recession, about as mild as it could be. I think from the perspective of whether that could morph into something worse, on the one hand, we have immigration keeping the economy afloat. All those people do spend money, provide some support. On the other hand, what's going to happen in the housing market over the next 6 months could be worse than we've anticipated. So we've just had some pretty weak local real estate board data. There's more people trying to sell homes now than trying to buy them. That suggests house prices are probably edging down again. And while immigration should provide some support, there's always a risk to sentiment, and we get a negative cycle of lower house prices, lower house price expectations, and a weaker recession, so a deeper recession for that reason.
And of course, even though we might not, we hope we get that mild recession you're describing, there will be those that are caught out, especially as mortgages reset. When we think about the kind of pain points, do you expect it to be a relatively small group of businesses or consumers that really can't manage through a higher for longer period on rates?
Yeah, generally a relatively small group in terms of, the share of people, but obviously that's no comfort to those people. But I think the problem when we think about financial risks is it doesn't matter if it's a small group. If those people are unable to afford their mortgages and have to sell, then that's normally enough to trigger sort of forced home sales and sort of weaker dynamics in the housing market. So that's still a concern, surely.
Stephen, great to have you with us. Appreciate your time today.
Thanks for having me. See you next time.
Stephen Brown, Deputy Chief North America Economist at Capital Economics. Coming up, interest rates are hitting hard, but what if it's just the beginning of a long period of high rates? Stay with us.